Can the bull market continue? Our next guest brings us insights from the current state of the U.S. private credit market. Randy Schwimmer is head of Origination Capital Markets at Churchill Asset Management. So I want to start real big here for people that are just thinking about, I'm in some index funds and I'm saving for retirement. What does the credit market have to do with the economy and equities? Like, what can we learn from talking to you about where we are right now?
That's a great question. We get that question all the time. The credit market is a large spectrum, right? And so on the most liquid end, you get a lot of volatility. The more public, the larger funds tend to be more linked to what's going on in the day-to-day news. The private credit side of the spectrum in private credit is, by definition, private. These are companies where we invest in, as an example, that are small, unrated businesses. So that tends to be at the lower end of volatility. So that side of the credit spectrum right now has gotten pretty popular over the last number of years because of the volatility in the public markets. We saw that in spades in December. And we're seeing a little bit again now, just given the fact that, with some of the trade-induced stuff that's going on, private credit tends to be relatively sheltered from that, and that's pretty attractive for investors right now.
Can you talk a little bit about how much private equity has changed, interest in those kinds of businesses? Because part of me, when they hear, well, you're insulated at that end of the market from the volatility, it's because, yeah, you don't have to market, but I mean, certainly there's going to be volatility and some challenges in that business along with the broader cycle. How have those dynamics of all this money coming into private equity that's looking for these types of deals where total ownership of a company and the multiple that they're paying for that has increased a little bit over the last years? Has that changed your business?
Well, the interesting thing about private equity is what's going on with valuations. We actually did a special report recently on it in our newsletter, The Lead Left. And there we've really focused on the value proposition for sponsors as a purchase price to EBITDA multiple. And that has been around 10 to 11 times even for smaller companies. Wow. And in part that's being driven by the enormous amount of fundraising that's going on, both in private equity for their investing purposes, but also in private credit that's helping to fuel some of this. The good news for folks like us who are very selective is that we can kind of pick and choose the kind of sponsors and industries that we focus on. And the sponsors that we work with are looking to do the same, to be specialists in the areas that they invest in, and obviously to kind of buy as low as they can in order to sell high, because that buy low, sell high mantra is really important for their investors to make sure that they're putting money to work effectively.
So on the point of valuations, I mean, we've heard this so often, especially given the big high-profile IPOs that we've seen recently. It's a lot of these tech companies that have maybe untraditional models that can be hard to price in. So as someone that kind of watches this space, how do you kind of grapple with the fact that a lot of these valuations have come up, and how do you kind of comb through the fundamentals or the numbers of these companies to figure out what's good and what's not?
Well, what we've learned, and we've done now probably about 600 deals in our 15 or so years that we've been doing this, and about 140 portfolio companies that we have. It's kind of the age of the add-on, and by that I mean that the companies that are being bought now are smaller companies that are being added to the platforms of private equity businesses. They may have to buy it at 10 times multiple to buy the platform, but then they go and they create these tuck-in acquisitions at lower multiples so that their effective purchase price multiple is lower. So when it then comes time to sell the larger platform business down the road, they're selling at a larger effective exit multiple. And so that's the key for these sponsors, is to buy the smaller businesses that are discrete, kind of niche companies to add on to the platforms.
Do you feel like there's a systemic risk embedded in some of this basically levered buyouts of companies that previously maybe had family-owned operations and they weren't really thinking about leveraging the business, but someone came in and said, hey, we could grow you 2 times if we lever up the balance sheet, and maybe things turn south and all of a sudden someone's left kind of holding the bag, because it feels a little bit like a Russian doll in some ways when you hear people walk through not just the initial acquisition, but tuck-ins and add-ons and all these sorts of things.
Yeah. So there are a lot of scary headlines out there, and we actually have written also another white paper that talks about how financial risk is really not part of what we do, certainly, and not even really part of the leveraged loan market, in part because of scale. So if you think about leveraged loans in general, it's about a $1 trillion market. Compare that to public equities at 30 trillion, or bonds, which are 40 trillion, so it's really much smaller. The middle market is a subsegment of that even, so you get really a small niche market. And then you think about the number of private companies that are out there, there's probably somewhere in the 7,500, 8,000 companies right now, middle market businesses that are owned by private equity companies. There are a total of 300,000 in this country. So as a scale matter, even those businesses that our clients are investing in is still small relative to the total. So the opportunity set is still very large.
So, I mean,
go ahead.
I was going to say, I mean, the funding, the name of the game has changed over time because of the fact that especially during the low yield or the low interest rate environment, it was so cheap for companies just to take out leveraged loans. I know you work with a lot of companies that are unrated, but how do you kind of reconcile some of the trends that we're seeing in the triple Bs and the high yield market against what we're seeing in leveraged loans, and what does that make in terms of an investment thesis for you?
Sure. So if you look at the underlying rate scenario that we're in right now, and it's a little hard to kind of put a pin on where rates are going because even the Fed doesn't seem to really know. But if you think historically, we're at a kind of 2.5% Fed funds rate, something like that. In July of 2007, it was 5.5%. Okay, so as a relative matter, interest rates are still pretty low. The yields, though, are fairly consistent if you look at middle market credit opportunity situations in private credit the way we are. It's kind of in that 7 to 8% yield range, give or take, which is still, if you think about it relative to high yield bonds, which are unsecured and subordinate in the capital structure, and we're secured by the assets of the business, the value proposition for private credit is a lot better because you have better yields, you're top of the capital structure, floating rate, so depending on where rates go, you're protected. And so that's why so much capital has come into this space. So when you look at volatility and the rate differential, it's attractive for investors.
Randy Schwimmer of Churchill Asset Management, it's great to see you. Thank you so much for coming in.